Greetings. Thank you for joining Knighthead Life to introduce our new suite of fixed indexed annuities. My name is Matt Johnson, Senior Vice President of Distribution here at Knighthead, and I will be leading our discussion today. Today is a really exciting time for Knighthead Life. We launched about a year and a half ago, and just recently, Life and Annuity Specialists reported that Knighthead Life was the second fastest growing new entrant into the annuity space through Q3 of 2025. Today, we're going to talk a little bit about who is Knighthead. We'll review some FIA challenges. We'll launch our new suite of fixed indexed annuities, and then we'll wrap up with a demonstration of a unique new tool that's available for you right now on our website called our Index Visualizer tool. So about Knighthead, so what is leading to this rapid growth and success from Knighthead? Well, it's really three things. It's experience, financial strength, and a fresh approach to our business with a lack of legacy business or legacy technology hanging around our neck. So who is Knighthead? Knighthead Life is part of the Knighthead Insurance Group, which is made up of Knighthead Life, Knighthead International, which writes MYGA and fixed indexed annuities for non-U.S. clients, some of it through U.S. banks and broker-dealers, otherwise through some international clients. And then there's Knighthead Reinsurance, which works with middle market carriers. And we've been doing this for about 14 years. This entire time, we've maintained an A- rating from AM Best. So that's another foundation of us, is our financial strength. And what this rating demonstrates is our consistent ability to manage our annuity liabilities in a responsible manner as part of the Knighthead Insurance Group. Another pillar of this is our fresh approach to the business and our lack of legacy operations. Knighthead Life built their technology stack on a cloud-native platform, meaning no legacy mainframe systems. This also allows us to be very nimble and digital first. What does it mean to be digital first? Well, it means if you write an application with us, that application is digital only. There's no paper applications, and those applications flow directly into our product admin platform, which means we don't need to have an army of case managers keying applications into a system. That also enhances the speed in which we can issue contracts. In fact, you'll see here that if you're funding the contract with an EFT, many times those are issuing same day. We also offer e-delivery for policy documents and very responsive customer service. So as your applications are submitting and we're working through the workflow, it's updating real time on your portfolio so you can easily keep track of exactly where our business is, where the case notes are, etc. Those are updated real time so you know right where your applications are. So the foundation of our success as we came to market was with a multi-year guaranteed annuity called Stay Sale. So I'll just do a real brief review of our Stay Sale multi-year guarantee. It's a unique offering in that it is a simple interest product. So we offer a 3, 5, 7-year surrender charge version with two different flavors, a no liquidity option that does not offer 10% free withdrawals, but has the highest possible credited rates. And then we offer a 10% free liquidity rider where withdrawals can start at year number 1. Simple interest products can have some benefits over compound products in that it's higher credited rates earlier on in the contract. They are also very good for income. You get a higher income level than you would with a comparable compound equivalent rate. In addition to that, a quick idea with our simple interest no liquidity rider, that is RMD friendly. So even though we don't have 10% free, you can still take RMDs out. Right now, the average retiree who's hitting their RMD, about 75% of them want to take no more than just their RMD. So there's a tremendous opportunity to offer guaranteed RMDs for 3, 5, or 7 years to cover those required minimum distributions. So on that note, let me switch over to introducing Chartline and Chartline Bonus, where upside potential meets principal protection with our newest line of fixed indexed annuities. So when we developed this product, we did a lot of research with our distribution partners and financial professionals, got a lot of feedback, and really identified 3 key challenges in the accumulation FIA space. The first one was overly complex features. Now, I'm a big fan of product innovation, but if it's hard for a financial professional to explain to their clients, or it's hard to understand the cost of a feature, that can lead to some frustration. There's also a competing challenge of the highest annual point-to-point cap, like an S&P 500 cap, with renewal rate integrity. And the third challenge is too good to be true, back-tested performance. And we believe that you sum this up and it leads to a certain degree of financial professional frustration. I've certainly gotten an earful and have been shared a lot of feedback with me over my many years in the business. So this leads to a new approach. We have three pillars in which we will follow as we explain Chartline and Chartline bonus. And the first one is the simple, easy to understand feature of guaranteed accumulation. The second is product transparency. And the third is performance you can trust. So we'll walk through each one of these pillars while we explain the product. So first of all, guaranteed accumulation. We are going to launch with 5, 7, and 10-year surrender charge products. And the simple, easy to understand feature is that no matter which version you choose, you are guaranteed to walk away with more money than you started. We'll do that two different ways. One is through a minimum interest guarantee, and the second is through a premium bonus. So what's a minimum interest guarantee? Minimum interest guarantee says that if you haven't earned at least a minimum amount of cumulative interest, we'll true up the contract to the difference. So as you can see here, the minimum interest guarantees are set at double the surrender charge period. So for a 5-year surrender charge period, we'll guarantee 110% of purchase payments. 7-year, 114%, 10-year, 120%. And you'll notice no annual fee for these riders. So as the example shows on the right hand, if after 10 years you haven't earned at least 20% cumulative interest, we'll increase to make up the difference. Now, when you run an illustration, we think that this is going to be a really interesting exercise with clients because this is going to serve as a confidence builder for clients, particularly your safe money investors, CD investors, fixed annuity investors, etc., where you can show them the illustration, and on the guaranteed run, we'll show them adding money to the contract to true them up to that 20%, 14%, or 10% minimum interest guarantee. The other options will come to market are upfront premium bonuses, and they will be similar to the minimum interest guarantee in that essentially they're going to be double the surrender charge period. So 5-year surrender, 10% premium bonus, 7-year, 14, 10-year, 20%, no fee on any of these options. These are available through ages 0 to 75, and then at age 76 to 80, there will be a reduced bonus percentage. But these will be some of the most competitive, no fee premium bonuses available on the marketplace. Of course, since it's a premium bonus, there will be a bonus recapture schedule. So compliance wanted to make sure we got those in there, and this will be part of the product material. The second pillar of our product design philosophy is product transparency. So I mentioned that competing priority of the highest S&P annual point-to-point cap with renewal rate integrity. There's a phenomenon we've dubbed cap subsidization in the industry. Where you've probably gone out and looked at comparisons on S&P annual point-to-point cap rates and seen some pretty wide differences in cap rates, and maybe some of them being outliers. You may be wondering, like, how can this carrier have such a cap so much higher than another carrier? Well, there's actually a 3-step process to implement what we call cap subsidization. First of all, the carrier sets a cap rate that is quite a bit higher than what they can actually afford to offer. Well, to pay for that, they have to set some other rates lower. And then they have to make an assumption on how much is going to go into the cap rate versus the other rates. Now, the risk to this, if they don't get enough allocation to the other rates that were set lower, they can wind up in a situation where they're over budget. Sometimes carriers will hope that the allocations will come back, and they may hold off for a number of years, overpaying for a rate that they can't afford. So the risk is you get in a situation where now, in future years, those cap rates have to start coming down. And they may have to come down more than what would have been an affordable rate to begin with. And we've heard feedback from financial professionals and distribution partners that this has been a very real experience for many of them. So how do we implement product transparency? We do it 2 different ways. One, we're simply not going to do cap subsidization. So you're not going to see us launching with a cap that's way out of the competitive landscape. Secondly, we will offer a subsidized cap, but we'll do it transparently through a model portfolio. So introducing our cap amplifier model portfolio, we'll have 2 other model portfolios as well, but this way we can actually execute cap subsidization, but done in a transparent manner, so you'll see what the rates are. Let's take a look at the cap amplifier model portfolio. So here you can see our 5, 7, and 10-year products. We'll be launching with a 12% S&P 500 cap on the high band 10-year product, 11.75, 7-year product, and 11.5 5-year product. Now notice that there's an allocation restriction of 50%. There are some other carriers that offer similar designs like this, but this will be the highest S&P 500 allocation percent that you can get in a transparently subsidized model. You'll see here that we'll have a 30% allocation to the S&P 500 daily risk control, but these rates will be lower than what you could get if you bought it outside of the model. Similarly, within the 1-year NYSE bond and commodity index, you'll have lower rates on these options than you'll have outside of it. So we say that's transparent because you'll understand how we're doing the subsidization. 2, it's controlled. You can't over allocate to this. And these will be rebalanced automatically each year on the anniversary. The third pillar of our design philosophy is performance you can trust. Now, there's a lot of custom indexes, also known as volatility smart beta indexes, that have come to market, literally hundreds of them over the last couple of years. And a lot of them have some really incredible illustrated performance. Well, guess what? It's not real performance, it's back-tested performance. And it may surprise you, or may not surprise you, but the index designers can actually over-engineer an index that can result in a very high back-tested result. But what a lot of financial professionals and distribution partners have seen when they go live, the performance looks more like this, right? So it turns out that there's a high correlation to too good to be true back-tested performance and poor performance when it goes live. Now, the industry is starting to talk a lot more about this. Recently, Life and Annuity Specialist had an article that was titled, "A third of top FIA carriers advertise illustrated returns of 16 to 27%. Now, through the rest of the article, they explained that about 2/3 of carriers are illustrating between 11 and 27%, but just 1/3 of carriers showed more modest illustrated returns of 10% less. Folks, we're going to be in the more modest return bucket, right? This is performance you can trust, and we'll show our index lineup of indexes that have many years of live track record, so you can actually believe in the performance that's being shown. Now, there's an implication to this. A second article that Life and Annuity Specialist had is called "The Rise and Fall of Volatility Controlled Indexes." In these indexes, so again, it's volatility, hybrid, smart beta, custom indexes, attracted almost 3/5 of allocations at the peak in 2021, but they have plummeted to around 26% of allocations today. So financial professionals are voting with their allocations. They've allocated these indexes, had very poor performances, gotten year after year of 0 interest credits, even though the market was positive or equity index was positive, they still received a 0. And they've said, you know what, I'm not even going to allocate to them. Well, we think that's too bad because there are high quality hybrid indexes that have great live track record that you can actually believe in. And we're going to tell you all about one of them in a minute. So this leads us to performance you can trust. First of all, we'll launch a core portfolio of 4 non-volatility controlled indexes. This is just your good old-fashioned S&P annual point-to-point with a cap. We have some additional great brand names that your clients are all going to know to complement S&P 500. And today we're going to be launching the S&P 500 Daily Risk Control 15 Index. This will be an uncapped index, so you get the benefit of uncapped upside potential, but you get some live track record that goes back to 2009. So real performance you can trust. Third index we're going to be launching is the NYSE, the New York Stock Exchange Bonds and Commodity Index. You notice there's no equity in the name. A lot of financial professionals and distribution partners shared feedback with me that when they have these indexes that have, say, S&P 500 and some other multi-asset classes like bonds and commodity, they run into this phenomena where the S&P 500 is positive, maybe even double-digit positive, but yet they wind up with a 0. And that's because they're simply not getting very much equity exposure. in a lot of these indexes. And that means if the other asset classes are negative, it can wipe out your equity return. So we're just going to decouple this. We're going to have a bond and commodity index that's designed as a diversifier. So it has low correlation to S&P 500. So if you want the benefits of diversification, you can add that to a portfolio for a percentage. And you know what? If the S&P 500 is positive, your S&P 500 cap will still have an interest credit. And if your bonds and commodity are negative, it'll just be negative for that portion. So it should make it a lot more simple and transparent to have those annual review conversations and talk about the performance of your fixed indexed annuity. Again, as we develop this lineup, it's all about creating a product that is going to have quality performance that you can believe in, is going to lead to better client experience and thus better financial professional and distributor experience. Here's our index lineup. S&P 500, Dow Jones Industrial Average, NASDAQ. Let's just start and say these are three names that everybody knows. When you turn the news on at night and you see what happened in the markets, you talk about the S&P, the Dow, and the NASDAQ. You got all three of them. That leads to confidence when you see names on your statement that you know. Then we've got our daily risk control we talked about. Again, live track record back to 2009, performance you can trust. We're also launching the Stocks Europe 600. This is an interesting index because, as you'll see in a moment, it's going to have a much higher cap than S&P 500. One of the reasons for that is the Stocks Europe 600 has a higher dividend yield. And when you buy a price earned strategy, you don't get the dividend, so you give up the dividend, which means we can afford a higher cap. And then we've got our NYSE bonds and commodities. Again, very low correlation to equities, meaning that many times when equities zig, the bonds and commodities have the ability to zag, which can result in a positive interest credit, even if the S&P 500 has been negative. Here's the rest of our model portfolio lineup. We have a global diversified, which is spread out across our index lineup. We have the American Benchmark Collection, which is a really cool option. And this is made up of the S&P 500 with a cap, NASDAQ, Dow Jones. If you like S&P 500 with a cap, for me, it makes an awful lot of sense to take a close look at the American Benchmark Collection. And then we've got our cap amplifier. So you can allocate amongst any of these options. You could split it up within a couple of different model portfolios, and or you can allocate to the individual strategy. So again, no restrictions on how you allocate. And I'll show you our index visualizer tool to actually help do some due diligence and better understand how to use these different indexes together to create better long-term performance and better outcomes. Here is our 10-year, or excuse me, our Chartline crediting rates for our non-bonus version. You'll see we'll launch our 10-year product, high band, 975 S&P 500 cap, 1175 on the Stocks Europe 600 cap, 70% par and daily risk control, 140 in NYSE bonds. Down here on the right, you'll see we do offer bailout rates. We set them very simply. If it comes with a cap, it's a 5% bailout. If it comes with participation rate, it's a 30% bailout. And then you've got your minimum interest guarantees right there as well. Here's our Chartline bonus rates. So again, we talked about the bonus 10, 14, 20. The bonus is the differentiating factor in each one of the surrender charge schedules. So the caps and rates are set identically. The only difference is the amount of the premium bonus. And then you've got a bailout rate that corresponds to these caps. So 550 cap on the S&P, 6 on stocks, 40% par on daily risk control, including that's on top of a 20% bonus in this example. So there's a few more technical details of the product. 25,000 minimum, single premium. One quick note on issue ages: Chartline non-bonus is issuable up through age 85, whereas Chartline bonus is only issuable through age 80. Ownerships will also accept trust, corporate owned. A quick note that at this time, we will not accept inherited IRAs for non-eligible beneficiaries. So those are essentially like the kids, where the inherited IRA has to be liquidated within 10 years of the date of death. We have to have some programming in place to ensure that we can liquidate those accounts within 10 years of the date of death. So that'll be something we're working on. A quick note on free withdrawals: 10% free beginning the second year. However, we are RMD friendly beginning in year 1. All right, next we're going to pivot over to the index visualizer, and I'm actually going to go ahead and pull up my browser and give you a live demonstration. So like I mentioned, this is available right on our website. You click on Financial Professionals and you click on Index Visualizer. We've got our model portfolios log loaded in here. You click the details, you can see the individual allocations and the rates available. Quick note, this is a product agnostic tool. So the rates that default in this are for the 10-year high band product, but these rates can be changed. Once you select an allocation option, you could go in and change the rate equal to what they're available on different products. You also have the ability to add a comparison strategy allocation, so you actually could do side-by-side comparisons. So I'll just start with a simple example with the S&P 500. I click results here. And what we're going to do is we're going to show some statistics. One, we're going to show what the average index result was, and then we'll show how many periods had a positive index credit. Now we can compare this on 1 year, 5 year, 7 year, 10-year rolling returns, but if we scroll down, you'll see we can also just easily check a box to compare some other index options. But really quickly here, what we can do is visually see how our rolling 1 year periods would have performed. So these are quoted on a monthly basis. So in this example, we're going back to 2009. You're going to see all the potential 1 year payoffs. So in this example, let's just pick a time period, February 27th, 2011, your S&P annual point-to-point cap resulted in a 2.9% interest credit. Here in January 30th, 2012, resulted in a 9.75. But the real benefit of the tool is the ability to really understand diversification, how these different indexes would have performed. So let's just click S&P 500 daily risk control. So here we can easily compare how these indexes would have performed through different time periods. Now, as we talked about, there's kind of this volatility control index hangover out there where a lot of people have been burned by them, but keep in mind, this is live performance that you can see. And you can go in here and see time periods. For example, here's a time period, May 30th, 2011, where S&P 500 was positive, but there was a zero return for the daily risk control. But the trade-off is you can see some time periods where you had some significant uncapped upside performance. So here your S&P capped out at 975, but the daily risk control would have resulted in a 21.35% interest credit. You know, if then we want to throw in a real diversifier on NYSE bonds and commodity index, we can really start to see some time periods where there is some significant different returns. So in this example, so we're in the heart of the financial crisis, right? In the S&P 500, the S&P 500 daily risk control, both negative, but bond and commodity ended up with a 12.93% positive interest credit. So again, by taking advantage of diversification, we can increase the percentage of positive interest credits. In other words, those statement conversations that you're having with your client, sitting down and saying, hey, look at this, the S&P was negative, but we still eked out some interest this year. Moving forward, having positive conversations resulting in a better experience with your clients. So again, you can build portfolios, you can compare different allocations, we can compare different rolling returns. So if I wanted to look at a series of 7-year returns and see how these would have differed, you can do that very easily. Again, an amazing tool to build confidence and help guide your illustration allocations when you go in and run your illustration. So summing our product launch up here, again, our design philosophy focuses on guaranteed accumulation, product transparency, and performance you can trust, which we believe will lead to better client conversations and better experiences for your clients. So our call to action, product training is live in Reg Ed. If you've already taken training, the Reg Ed code for existing agents is KHL_FIA. And if you're brand new to Knighthead, which we hope we get to bring many new friends into the Knighthead family, KHL_all. So take a look at that and get out and complete your product training. And if you have any questions whatsoever, don't hesitate to call the sales team. We are open for business. So thank you very much for taking your time. We're very excited. Let's work together. Thank you again for tuning in. This concludes the presentation.